Wonderful. Love that last presentation, by the way. Thank you guys for that. That was really, really good. And excellent presentation. I love good, honest information like that. And all the presentations so far today have been fantastic. I love what they do here at Real Traders. It is such a powerful opportunity for people using technology. I remember back in the days of yore, I used to have to travel all over the country to go to conventions like this where you'd hear different speakers and you have travel expenses, hotel, airfare, oh my goodness, meals. And now through the use of technology, we can have all the speakers come to us wherever we are in the world. It's just amazing. So thank you guys. You are doing a great job and really appreciate you bringing this service to traders around the world. And I'm just thrilled to be a part of it. So anyway, welcome everyone. We have a huge crowd here, I see, and that is fantastic, very exciting for me. Let me jump right into it, and I'm going to be sharing with you a little bit about, oops, I just got a little message here. Okay, problem. Yes, I'm going to be sharing with you my my favorite trading method of the last 10 years. I've been a trader pretty much all my life, as you'll see here in a moment. And over the last 10 years, I developed a trading methodology that has worked better for me than anything else. And so I thought, well, that's the best thing to share with all of you today. So, by the way, don't have anything to sell you today, so you can keep your wallets in your pants and in your purses. I am going to give you a free offer, however, and that is one of my mini courses, absolutely free. It's a correspondence course that gives you a lesson every day over the period of 5 days in video format. And each day you get a new video emailed to you, and at the end of that video there's an interactive quiz, so you can actually quiz yourself. And on day 4 I actually give you one of my very favorite trade setups. And this is a good trade setup. It's a valid trade setup. It's not some old trade setup that doesn't work anymore, so I give it away for free. It is actually one of my favorites to this day. Every single time it sets up, I still take this trade setup. It's that good. Very, very, very high win-loss ratio. And you'll be getting that as part of that free course. So at the end of the webinar, on the last slide, I'll give you the website where you can go get that free course. And in the meantime, I'll share with you a little bit about myself so that you know who I am and who's talking with you today. As I say, I've been in the trading world pretty much all my life because my dad was a trader. It was his avocation and passion in life. So I really had no choice. He just loved trading. And like anybody who loves something, he talked about it day and night. So I heard about it day and night. But that was okay because it became something that we shared in common, and it became a real bonding experience for us. And my dad started teaching me, gosh, I guess I was maybe 6 or 7 years old, and he started me with stocks because he traded mostly stocks, but then later I moved into futures and commodities and, of course, currencies, Forex, and options, and I trade all of those things now. But my good old dad got me started, and for that I will always be grateful to him. And then I took on many other teachers and mentors, hired several people to work with me personally. That became pretty good, and some of my mentors recommended me to some organizations, and they started inviting me to teach and say, hey, share with us what you're doing. And so I did. I'd go around to some trading clubs and so forth, Worldwide Traders, Day Traders USA, and eventually got sponsored to do traveling, not to go to courses, but to actually teach courses. And so I did the seminar thing around the country, and that was great. I got tired of that after a while because of all the travel, and I had a young family at the time. So came back and decided to just stay at the home base, but then FuturesTalk.net contacted me, and they run a chat room, and they wanted me to be their head moderator. So I did that because I could do that from the comfort of my office. So I opened and closed the market every day with them. Went and got my doctorate in hypnotherapy, got certified in neurolinguistic programming so I could help people with the psychology of trading, because I found out that that was one of the biggest struggles that consistently came up. was the psychology of trading for people. So I'm able to help people with that now. And we've won many awards and so forth, but if you want to get my full bio, I don't want to talk about myself here anymore, but if you want my full bio, it's at my website, topdogtrading.com. Feel free to go there and you can read all about me if you want to do that. But let's move on. We're going to start here with a little bit about the psychology of the market, since we're on that topic, because that really is what moves the market. Now, market psychology operates on two different levels. One is your own individual psychology, and that comes to discipline, keeping rules, and so forth. And then there's another level at which the market works, and that is group psychology or mass psychology. So the first thing that we want to know when we start trading is we want to deal with reality. There are so many different trading approaches and plans and strategies and methodologies, and there's definitely more than one valid one. There's multitudes of them, and I've gotten to know a lot of people in the trading world over the decades, of course, and I've seen people trading many, many different approaches successfully. So there is no one way that works. There's many different approaches that can work. But when I approach the markets, the first thing, I'm a very practical person. I'm not big into theory or conjecture or mysticism or magic numbers or any of that kind of stuff. I'm very practical. And one of my mentors, in fact, was a floor trader at the CME, and I got an apartment out in Chicago and worked with him for a while. And it's really different. I know one of our previous speakers was a floor trader, and that was great, by the way. Thank you for that. But it's a great experience, if you haven't done it, to go there, and especially if you can get on the floor and if you can get sponsored by a brokerage firm or a trader or something, to get down there and talk with people and spend a while and see what the market really is. Because as screen traders, it's real easy to your computer screen and think that the market is wiggles and jiggles on indicators or candles or lines that you draw. The market is not that. That's not what the market really is. So let's talk about what really moves the market. What is it? First of all, do fundamentals matter? Well, yes, they do. In fact, my good old dad, he traded primarily on fundamentals. Now, he used a little bit of technical analysis. He used some price patterns, two moving averages, and volume. But primarily he used fundamentals, and again, he was more of a stock trader. Do they matter? They do. They absolutely do. But for me, I got away from relying on them too much. And the reason for that is because, well, we've learned over the years that fundamentals are not always reliable. We've found that a lot of companies do book cooking. Sometimes the market goes up on good news and down on bad news. Well, that's what we would expect. But then other times the market goes up on bad news and it goes down on good news. And that's because the Dow theory of discounting. Sometimes, quite often, in fact, people, as you've probably heard the saying, buy on the rumor, sell on the news. And so people are always trying to get in, anticipating market movements. And so by the time things are known, by the time there's a certainty, it's too late. And so it's a little counterintuitive, but that's really how the market trades a lot of the time. So very hard to trade just based on fundamentals alone. You might think that, oh gosh, you know, this country's economy is doing great and so forth, but people might think it should be doing even greater. And so even though the news is good, they'll still sell. So it's very unpredictable, and with timing especially, it's very challenging. So the bottom line is, it's not news that moves the market. It's not economic reports that move the market. It's not the indicators on your charts that move the market. It's people. People move the market. The market really is people. It's an auction place, a giant, huge, massive auction place. And so the market moves based on people's beliefs and their feelings. So again, news can come out. Does that news move the market? Well, not really. You might look like it because the news report comes out and bam, the market moves. But it's really people responding to that news, buying and selling based on what they believe about that news or what they feel about that news. Was it good, or was it good enough, or not quite good enough? What do they think that means? Sometimes they'll buy and then, 2 minutes later, they'll sell dramatically. Yes, the market moves based on people's actions, but again, here we're not talking about individual psychology. When we talk about the movement of the market, for example, the euro or the yen, then we're talking about it takes lots of people to move the market. So it's mass psychology. It's not individual psychology. And mass psychology has different principles than individual psychology does. People move, or people act en masse as a group differently than they behave as individuals. That's very important to understand. So fundamentals, helpful, good. Believe me, I always am aware when pre-announced news is going to come out. Yes, absolutely. I'm aware of those times, and I'm watching them. But for me, I'm primarily focused and basing my decisions based on technical analysis. And my definition of technical analysis is the mathematics of mass psychology. And watching how people behave, and then technical analysis expresses that in mathematical terms. Okay, so what's the nature of the markets? Well, as I said, the movement of the market is the movement of mass psychology. Therefore, the nature of the market is human nature. Now, this is very helpful. See, this is where we start when we decide on how we're going to trade, what type of approach we're going to take to the markets. We have to ask ourselves first, well, what moves the markets? What is the nature of the markets before we can determine a valid and responsive methodology? We got to make sure that it's based on the reality of what moves the markets. So to me, charts are maps, and they are maps of that collective human behavior. So the market isn't like people, it is people. Nothing gets plotted on a chart until people take action. And I've got some words here that are in caps. Behavior, action. It's very, very intentional, because charts don't map just people's thoughts, beliefs, hopes, and fears. They actually map people's commitments. Because if you know anything about people, and I think we all do, sometimes, in fact, a lot of times, people will say things that are different than what they actually do. And in fact, that happens a lot, doesn't it? People will tell you all sorts of stuff, but when it comes down to what they actually do, it can be very, very different. So you can listen to the pundits, you can watch the advisory services, you can listen to, your friends and what they have to say at the party about the markets or in the locker at the gym room, but that means nothing until people put their money where their mouth is, and that's what charts are about. It's not just putting in a bid or just putting in an ask. It's actually buying. It's actually selling. It's committing their money. Now, that's when they are serious. That's all I care about. I mean, I've literally sat next to a major trader, is a friend of mine, and this guy trades huge volume. And he literally, I've seen him, and he's explained this to me, he will sit there and he will put in bids and asks above and below the market. And because he trades such huge volume, and he'll do it in some of the smaller liquid markets, people see those bids and those asks, and that's exactly what he wants. And he can start to, he's trying to manipulate the markets in a way, trying to show that, oh, there's some interest here. Well, but guess what? As soon as it comes close to actually being filled, he pulls the order. And so, is that a serious commitment? No. Absolutely not. And it never gets plotted on an actual chart, unless, of course, you have a chart that does map bids and asks, but I don't use those for that reason. I just want to know if orders are actually executed, because that is people's commitment. Don't tell me, show me, prove it. And when people put their money where their mouth is, that's what's important. So that's what charts are. Charts map people's commitments, and that's why I like technical analysis so much, and it's showing me what's happening right now. Fundamentals are more based about, you can conjecture what people should say or what they should do or how they should respond. The charts show you how people actually are responding. Okay, so now if the nature of the market is the nature of people, well, what's the nature of people? And how can we apply that to the market? So briefly, the nature of people is that, first of all, we are goal-oriented. That's just a natural part of our personalities, of how we function in the world and in our environment. Even as little babies, we have a goal to be able to become mobile and to feed ourselves. These are all survival things that are very, very important. And to grow up and to be able to fend for ourselves, to get married, to procreate, to get jobs. People have their own paths, of course, but these are some of the things that are just part of typical goal-oriented aspects of human nature. And so it is whatever goals people tend to have, we do have a process of moving from here to there. In the markets, we call that a trend. So trends are very natural. They're an expression of human nature. On the other hand, our goals in life, we never seem to be able to go straight from here to there. And so life is full of wiggles. Life is not neat. And so we even have a saying that as we move toward our goals, it seems like it's 3 steps forward and 2 steps back, because that is our experience of moving toward our goals. And in the markets, the same thing. Markets rarely go straight up or straight down. They usually wiggle up and wiggle down. We call those oscillations. And then sometimes in life, we don't even go 3 steps forward, 2 steps back. Sometimes we just get stuck on our way toward our goals. We just get stuck. And we've got to figure a way to get out and get back moving. And in charts, we see that as consolidation. Also, part of human nature is that we can't just keep going toward our goals without any rest. And so we have cycles. Human beings breathe. We have respiration, inhale, exhale. We have cycles in our heartbeat. We work during the day and we sleep at night. And so the human beings are cyclical by nature. And we see nature, or we see that same nature reflected in the charts and in markets that have cycles. But cycles are also not that neat. I've seen charting platforms that have cycle indicators on them, and they're very, very nice and neat and clean. And they allow you to create, for example, maybe a 20-period cycle or a 19-period cycle or a 40-period cycle, and then they will mark out the next 40 bars, and 40 bars after that, 40 bars after that, 40 bars after that. Unfortunately, the market's not that cooperative, and so cycles are not consistently regular at all. So it's just like human beings, though. Gosh, when I was in graduate school working on my doctorate, we would stay up at night before midterms, finals, major papers. In fact, sometimes we'd stay up 2-3 nights and study together as groups. And then after the big paper was done, or the final exam was done, we would crash. And that is, again, kind of natural. When people have something that one of their goals is pressing and urgent, boom, we go a little beyond, we push ourselves on our normal cycle. And we work all year, and then we take a little vacation, or maybe a little big vacation in the summer. And again, that's human nature, and that also is reflected in charts in the sense that, again, cycles are not regular, but they expand and they contract. Sometimes cycles last for a long time, and then other times they contract and they become short. And this is what makes it somewhat challenging to actually measure and predict cycles. Human beings are also very, very emotional. We love, we hate. We overreact, and then we get passive-aggressive. and we're certainly not always logical. Now, this is a very interesting aspect of human nature, and one of the subtleties of it and nuances of it is that most people believe that they are logical, that they are primarily logical. Most people will acknowledge that they have both logical and emotional aspects to their personality. I've consulted with companies and I've met a lot of CEOs and worked with them, and especially the CEOs, they will acknowledge this, and they will even say that most of their potential customers make decisions based primarily on emotion. But then they will say, but of course I make my decisions primarily based on logic. And I usually don't say anything because I'm not going to convince them otherwise, but as I work with them over the months or up to a year, I watch their behavior. Again, it's not what people say, it's how they act. And as I watch the behavior of even these top executives and CEOs, again, I observe that they indeed are making the vast majority of their decisions based on emotion. Now, they think they're being logical because indeed they do use logic as part of their process, but mostly what they do is they use it to justify their emotional decision. And that's what most psychological studies have shown, is that people make most decisions based on emotion and then they justify them with logic, because in our culture we tend to value logic more than emotion, and so therefore we are not comfortable believing that we would make a decision, especially an important one, based on emotion. And so we hide that fact from ourselves, and we make those decisions based on emotion, but then we justify it with logic so that we allow ourselves to follow through on that decision, and then we think we're making a logical decision. Where that applies in the markets is very, very important. Again, the markets, so many trading methodologies, in fact, most of them that I have seen, assume that the markets are rational, that they make sense, that people make decisions based on reason. And especially when it comes to money, people get very irrational. And so it just simply is not true. Sometimes people do, sometimes they don't, but more often than not, they don't. And so any trading methodology must be able to take that into account, and this is where so many of them fail and falter, and then they wonder, well, gosh, the market should have done this, but their assumption of should is based on logic. And when people don't make logical decisions and buy or sell for logical reasons, then the system falters. Okay, now let's take it down to the level of individual psychology. What about me as an individual? So Plato's principle comes in here, and Plato's principle is basically what most people know as the 80-20 rule. So I don't know if there's any official statistics on what percentage of people make money. I've heard 5% of the people make 95% of the money. I've heard other numbers as well. I don't know if there's any official report of that specifically worldwide. But the bottom line is the vast minority of people make the vast majority of the money in the markets. So knowing that going in, we realize that as traders, golly, most people don't, and yet I still want to participate in this business. So therefore, in order to participate in this business, knowing that fact, the good news is I must think that I'm different than the masses, because I've already acknowledged the masses don't succeed. The bad news is everyone who participates in the markets only participates because they think they're going to make money. And so therefore everyone thinks they're different than the masses. And therefore, by definition, you're not thinking different than the masses at all. You're thinking exactly like them. Okay? Now, that's kind of a brain twister there, but it's an accurate one. The problem is if you think like the masses and the masses lose, you will lose. You need to learn to think different. Now, in Chinese philosophy, this is called an iron circle. In the West, we would maybe think of it as something similar to circular thinking, but it's not precisely circular thinking. In Chinese philosophy, when they look at something like this, They say that it's an iron circle because as long as you continue to think this way, you are stuck. You cannot get out of this conundrum. You've got, in other words, let's walk through it again. In order to participate in trading, knowing most people lose money, you've got to believe you are going to be one of the minority. On the other hand, everybody participating thinks they're one of the minority, otherwise they wouldn't trade. Therefore, you are one of the majority. Okay, so you're stuck. It's an iron circle. So the Chinese then say, well, how do you get out of that? You cannot think that way. You have to do something very, very different. And so what you have to do is you have to transcend the iron circle. And in Western words, we might say, in Western terminology, we might say you need a different paradigm. So what I do, and here's a little thing. I've got a little extra time here. I'm doing well on my time. So I'm going to share with you a little exercise that I've done. Okay, I have taken this fact of how people think to use it to my advantage in a little biofeedback thing, not with the biofeedback tools and so forth. And then here's a little exercise I've done that you might find interesting. I've actually done this, and you might find it helpful to do it as well. So here's how I transcended that iron circle, that loop of that paradigm. I went into a number of trading chat rooms. Now, the trading chat rooms that you want to do for this exercise are not the ones where you have a professional trader. I'm not going in to hear the professional who's doing well. I'll listen to anyone who's making money. I wanted to go into the trading chat rooms that had the losers, that only had amateurs, and people are just talking to themselves back and forth. Now, what I would do is I would listen to them and I would watch the charts that they are watching, knowing that most of these people are losing money. And I would just sit there day after day after day, week after week after week, month after month. I did this for about 6 to 9 months. And of just listening what they would say and watching what the chart would do. And of course, the vast majority of the time that they said, oh, here's a great opportunity, I'm going to buy the euro here. Oh my gosh, here's an opportunity, the yen is, overextended and overbought, I'm shorting. The vast majority of the time, they were wrong. Wrong. And I watched them lose. What I started to pick up, because of the repetition and doing this for so long, was I started to pick up patterns. Patterns of how they thought, because I would hear them say the same things over and over and over and over, and even the same phrases over and over and over. And I would see them, as I watched that in coordination with the charts they were trading, I started watching them trading the same chart patterns, and of course losing consistently. So I could match the words with the chart. And there were certain patterns that would reoccur over and over and over and over again. And because I did it for so long, I actually got that ingrained in my brain cells, so pretty soon I could just look at a chart, and even without having the chat room sound turned on, I could, in my brain, I would just hear what all the amateurs were saying about that chart at that time. And then, of course, I would know to do the opposite. So I'll just give you one specific example. This is one that came up all the time. So probably the most common one that happened, actually. So the market would be going up. Let's say it's the yen. It's going up, making higher highs. And then a bunch of people would say, oh my gosh, this is so overbought. And, they refer to whatever indicators they were using. CCI was common, stochastics was common, MACD was common, RSI was common. Probably those were the most common ones. They would refer to different resistance levels that it had gone through, Bollinger Bands, whatever. And they would just say, oh my gosh, this market is so overbought. It just can't, and this is one of the phrases that I would hear over and over, it just can't go any higher. Well, as soon as I heard somebody can't go any higher, of course I knew it probably is going to go higher. And most of the time it would. They would short. They would take a short position, and the market would go down just enough to fill them. And then it would turn right around and make a higher high. And of course, they get exasperated, put in a few colorful characters into their chat box. And as the market made another higher high and got even more extended and more overbought, the same people would say, okay, well, now it definitely can't go any higher. This is crazy, crazy, crazy. This is way overextended. I'm shorting. This is a sure thing. By the way, that was another one of the phrases you can almost bet on. Whenever they say it's a sure thing, it's not a sure thing. The more confident they were, usually the worse the trade it was. And so again, sure enough, market would come down a little bit to fill their short, and then turn right around, make a higher high, and stop them out again. And they would do this sometimes 3, 4, 5. Most of them would quit after about 5 times. I saw some people do it 6, 7, 8, 9 times, and the market kept doing it up, 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 until finally people would say, oh my gosh, this market's crazy, it's not making any sense, I'm going to play golf. So that's just one example, but there were many examples like that. So you might want to try that. I found it extremely, extremely helpful. Okay, so here is just a very plain chart of the euro. And for most people, charts are like a Rorschach Inkblot test. And so here we got a 60-minute chart. And I'll tell you what, let's just do a quick little test here. Not even a test, just kind of a little survey. At this point, on the hard right edge of the screen, type into the question box. How many of you think the market will go up from here? How many of you think it will go down? And how many of you think it will just consolidate and basically go sideways for a little while? Okay, let's see what we got. So go ahead and type it in the question box. I'll read them here. I don't know if you guys can see the answers. So we got up, down, 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 sideways. Definitely, oh, there we go. Up, down, sideways, up, 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 down, don't know, down, sideways, sideways, up, both. Wow, that'll be interesting to see it do both. Up, sideways, and up, down, down, consolidating, sideways, up, down, don't know, down, 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 sideways, up, down, 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 sideways, down, probably sideways, down, down. Okay, several people say they don't know. That's probably good. All right. So we'll see. Well, yeah, we'll see, but you know, when you're trading, you can't say we'll see. You got to trade right now. At any given moment, you got to put on a trade. So, okay. What did we see? We saw a pretty even distribution of people saying up and down, and then a little smaller number of people saying sideways. So that is the market. That is the market. If you're going to buy, someone's got to be on the other side of your trade saying you're wrong. If you think it's going up, there's someone on the other side saying, no, it's going down, or they're covering a position. If you're shorting, then someone's going to say, nope, you're wrong, and they're buying. They're taking the other side of your position. Now, of course, it's not quite as simple as that. I'm oversimplifying, but basically, you have people on both sides of the trade. And so you can't rely on just, that's what the market is, right? People saying up, some other people saying down, some people saying sideways. Who's right? Who is right? You need something. You need an edge. You need trading is a competition, in other words. And so you've got to have an edge over the person on the other side of your trade. You've got to see something they don't see, or understand something they don't understand. You've got to have an edge over them. So this market happened to go up, just to satisfy your curiosity. That's what it did. It went up after this. Okay, so all of you who set up can congratulate yourself, and but you know what? The fact that you set up is probably meaningless, because being right on any one given trade is meaningless. What's meaningful is when you establish a probability scenario over a large sample of data, it can be consistently profitable, have a good risk-reward ratio and a good win-loss ratio. So for many of you, I mean, some of you may have actually had a good reason for saying up, and for a lot of you, you probably got lucky. And the next one, maybe not so much. Can't depend on luck. One of the worst things that can happen when you become a new trader is to actually make money, a lot of money, because you get overconfident. You think you actually know what you're doing, and it could just be luck of the draw. Okay, so let's define the human nature in charts here. Let's move on with this concept. We say things like, well, I finally found my direction in life. Okay, in charts, that's a trend. We say, hey, I'm on a roll. In charts, that refers to momentum in the market. We already talked about 3 steps forward, 2 steps back. Oscillations or cycles in the market. We talk about our life hitting a wall. Okay, in a chart, we see that expressed as support resistance. A lot of people, when faced with a decision, they'll say, well, part of me wants to do this, but part of me doesn't. And that I refer to as the energy of fractals. And fractals refers to looking at the same thing on a different scale. All right? So we take these same things, these human expressions, these human experiences, and we understand that people take their human nature into their trading decisions, and so we look at them on the charts. Now, my charting methodology, let's get right into the trading aspect of this and take it all into trading now. My trading methodology is about defining energy in the charts. And I call mine a methodology because it is very methodical. It's very objective. It's very rule-based. And so I'm looking at energies. What is the energy in the chart? So there's 5 energies I look for on any given potential trade. So let's just list them. Again, I already did, but here's what they are. Trend. That's the first thing I always look for. Am I looking to buy or sell? What's the direction of the market? Number 2, momentum. Just because the market's going up does not mean I want to buy. It could be a weak trend. So I need to look at energy number 2 and determine, is it a strong trend or a weak trend? Momentum is what helps me determine that. I'll only buy with the trend or sell the trend if it's strong. Cycles is energy number 3. Is telling me when to enter the market. It's timing. And then support resistance. That's a blockage of energy. So I want to buy off a blockage of energy. I want to buy off support or short off resistance. Also take profits into those levels, knowing those are a blockage of the first 3 energies. And then fractals, as I say, is looking at the same thing on a different scale. So in trading, that means trading multiple time frames. So if I'm looking at a 5-minute chart and trading a 5-minute chart, then my fractal energy would be the 15-minute chart. If I'm trading a daily chart, then I'm going to look at a weekly chart, and the weekly chart I refer to as my fractal energy. Now, again, since I'm trading a method which is objective and rule-based, I need an objective way to measure the energy in the charts. So I need instruments that are objective. I don't want to just wing it. I don't want to look at a chart and say, well, it looks like it's going up, so I think the trend is up. No, that's too subjective. That's too discretionary. I need to have certainty and clarity. Every time I take a trade, I am very, very clear that this trade meets my rules. There is no question about it whatsoever. There's no gray area. It's black and white. Yes, very clear. And that's because the tools that I use to measure the energies are black and white. So in general, the tools that I use are I use a moving average. For momentum, of course, I use a momentum indicator. For cycles, I use an oscillator. For support resistance, I use previous cycle highs and lows, previous wave highs and lows, floor trader pivots, and Fibonacci levels. And for fractals, if I'm doing intraday trading, I do a chart interval 3 times the setup chart. So as I said, if I'm trading a 5-minute chart, then my fractal chart would be a 15-minute chart. Now, why are we doing this? What's the purpose of measuring these energies? It's all about determining a probability scenario. So as I said before, we never have an absolute certainty of what the market's going to do. It constantly amazes me how people think you can predict the future of markets, of currencies. But in other areas of life, they would never assume that. So what makes you think that you could forecast something and determine it with 100% certainty when it comes to the markets? I mean, one of my favorite sayings about the markets is that anything can happen at any time. Or sometimes it's phrased, the market can do anything at any time. You can have a surprise news event. It could be economic, it could be war, it could be terrorism, God forbid. Anything can happen at any time. And if those kind of dramatic things occur, the markets don't care what your CCI says, your RSI, your stochastic, your MACD, or your Fibonacci, or your candlesticks. The market's going to have a knee-jerk reaction to that information. So we never have certainty. So what we do is we determine probabilities that work over a large sample of data. So how do we do that? Well, here's how I do it. At each potential entry point, I ask myself how many of those 5 energies are aligned, all saying buy or all saying sell. Based on that, I give each setup a score of 1 to 5. The higher the score, of course, the higher I consider the probability. I liken this to taking each trade to court. I need 5 independent witnesses to establish a preponderance of the evidence. Now, the operative word here is independent. You see, these 5 energies are all different. I'm not using 5 trend indicators or 5 cycle indicators. That would be redundant. The point that makes this work, that makes this significant, that actually creates a probability scenario is that trend is not correlated to momentum, and momentum is not correlated to cycles, and cycles are not correlated to support resistance, and that's not correlated to fractal energy. They're all independent of each other. So, therefore, when they agree, it's significant. That's the point. That's what makes it significant, when they agree and puts the odds on our side. Okay, let me walk through those 5 energies again, but this time give you a little more detail and show you some charts. So, as we go through these 5 energies, we'll just take them one by one. Energy number 1 is trend. It simply means direction. For that, the tool I use is the 50-period simple moving average. And that's the red line on the chart. I don't want to use a short-term moving average. I'm going to use a intermediate moving average. Now, many people say that a trend is defined by higher highs and higher lows. In fact, that actually is a very classically accepted orthodox definition of trend. The problem is that it doesn't really necessarily agree with the dictionary definition of trend. Webster's dictionary defines trend this way: to extend in a general direction. So to extend in a general direction is referring to a long-term move, not a short-term move. Well, here in this little blue ellipse, we've got a higher low and a higher high. So is that the trend of the euro here? That is not the extended general direction. So I would say no. That's just a little complex retrace up in an overall downtrend. A red line, the MA, shows the downtrend. From a practical point of view, from a business point of view, we want to be trading with the trend because it is the long-term move. And therefore, trading in the direction of the trend means we get a better reward to risk ratio. So while amateurs would buy here, and again, this is the kind of thing that I would see in those amateur chat rooms. They'd say, oh, I'm going to buy here. Why? Because they would see a reverse head and shoulders. Left shoulder, head, right shoulder. First of all, that is not a reverse head and shoulders. They don't understand the proper formation of a reverse head and shoulders. So they're completely wrong. That is not a reverse head and shoulders pattern. And so, but I love it when they do that, because then I'm just saying I know there's going to be people doing that, and I'm going to be fading their trade. I'm going to be taking the other side of their trade. Why? Because the overall direction of this market, the long-term move is down, and I want to trade in the long-term direction. So I'll just wait till we get this nice spike top candlestick pattern here, and I'll short. I'll take the other side of their trade here, and boom, 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 and it goes down. See, their reward was that. My reward is that. Now, energy number 2 is momentum. Again, I don't trade just based on trend. In fact, I won't take a trade on any one of these energies or any one of these indicators. In fact, there's a lot of people who don't use indicators because they feel they're not accurate, they're lagging, whatever. And I halfway agree with them. You know, I really do, because none of these indicators by themselves have made me any money. So I don't do that. Remember, I'm only trading when I get the 5 energies aligning, all saying the same thing, because I have found that one of them by itself really does not give you a probability scenario. It's not reliable enough. So for trend, I also have to have momentum. So here's a higher high, higher low, higher high, higher low. Well, our chart, our price pattern shows an uptrend. Our 50 MA shows an uptrend. But when we look at momentum, we see, okay, here's our momentum indicator. It holds above 0, and therefore that's considered a strong trend at that low. At this low, how would we know to stay out? Well, because now when we look at the momentum indicator, it has made a lower low, even though price made a higher low, and it's gone down to 0, meaning there's no momentum, no strength left in this trend. So it's still, at that moment, it is still an uptrend, but this is where the 50 MA and even the price pattern is a lagging indication of the future direction of the market. But momentum can be, and I do use the word can be, a leading indicator. It isn't always, nothing always leads the market, but as a potential leading indicator. What it is showing, though, is weakening of the trend. And therefore, again, there's going to be people who buy this, and then by seeing this, see again, this is something most people won't see. Remember I said you need to see something other people don't see, your competition especially, so that you have an edge over them. Most people aren't going to see this. They're just going to look at the trend. I'm going to see this. I'm going to see the engulfing candlestick. I'm going to see momentum is now shifting to the downside. Momentum is leading price, leading trend, and I can fade them here, or here, or here. Energy number 3 is cycles. As I said, markets don't go straight up or straight down. They wiggle up. They wiggle down. They're the rhythm of the market. They're the inhale and the exhale of the market. Charts are two-dimensional objects. You got price on the right and time on the bottom. Cycles are about timing. And of the two, W.D. Gann said timing is actually more important than price. It's very interesting to me as I look at amateurs' charts, and I've seen a million of them. Most people have way too much information on their charts, first of all, way too busy. But very rarely do they have any good timing tools. Most of their tools are all based on price. And yet, again, a chart is a two-dimensional object, so half of the information is time. So, how can you establish a probability scenario, put the odds on your side, if you're ignoring 50% of the information on a chart? Big mistake amateurs make. Support resistance is energy number 4. Here I show Fibonacci levels. Again, by itself, Fibonacci levels, useless. Just take a cursory glance and you can see price going through some lines and bouncing off others. Well, how do we determine which ones they're likely to bounce off or which ones they're likely to go through? Again, by itself, we don't know. So we have to use it in line with other energies. So let's just take this last one for time's sake here. Comes up here, what do we got? Well, that resistance, first of all, it's a cluster of that wave high and the 50 fib. Ironically, the 50 fib is not a fib at all, but it's a very, very good number and a very reliable one. So first of all, it's a cluster, double resistance there. Number 2, engulfing candlestick. Number 3, trend is down. Even though price is above the 50 MA is angling down. Therefore, we are looking for shorts. Number 4, our cycle indicators turning down. See how it turned red there? So we're putting in a cycle high. And then finally, look at momentum. As price goes down, momentum pulls far below the 0 line, far below the 0 line. When price goes up, it barely gets above the 0 line. So the strength in this market is downside. Therefore, we're wanting to go short. And again, the reward is more to the downside. And finally, the 5th energy, the fractal energy. And here is our setup chart on the left. You see price meandering below the 50 MA. That's our directional indicator, so now we're looking for shorts. Also provides resistance, engulfing candlestick high. cycle high, momentum below zero. So everything there aligned to go short. Before we can take that trade, though, we need to look at our fractal chart. That's 3 times. I'm using tick charts in this example just to show a bunch of different time frames. So it's 3 times the 100 tick chart. Now, of course, using multiple time frames is not anything unique to me, but I do it differently than most people I see. What I've seen a lot of people do is say, well, I will only take a trade on the subchart if it's in the direction of trend on the higher time frame. For me, I don't rely on trend on the higher time frame. Reason is this higher time frame is slower. Obviously, 1 bar here for every 3 bars over here. And number 2, we've already shown on that momentum chart, where we're showing trend and momentum, that trend is lagging. So I don't want to use a lagging indicator on a slower chart. The timing is just not really tightly correlated. So what I do is I want to use the potentially leading indicator. So when I look at the fractal chart, the next higher time frame, my rule is I'll only take the trade if it's in the direction of momentum on the higher time frame. And I also like to trade it in the direction of cycle on the higher time frame. So, high probability trading. Let's summarize here with our last couple of slides. Everything can work sometimes. Nothing works all the time. There's no certainties in the market. But with your money on the line, you're going to want to know, or at least have an idea, is there a high probability, are the odds on my side, that it will work this time? This time meaning any given trade you choose. The way that I do that, I wait for the alignment of the 5 energies to put the odds on your side. And my method is very simple. You know, it's funny, I went to I was asked to speak at a trading club a little while back, and so I flew out there and I had dinner with the main guy and some of his close friends, and they were putting together a trading plan. They weren't done yet. They brought it to dinner, and they showed it to me a little bit. So far, it was 200 pages long, 200 and some pages long, and they weren't done with it yet. And I was just aghast. Wow. Okay, my trading plan is 1 sentence long, and here it is. And it's in this order, by the way. Always look at things in this order. Again, keep my method very methodical. So first thing I look at, number 1, energy number 1. What's the trend, up or down? Am I looking to buy or sell? Or is there no trend? Number 2, then is that trend strong or weak? That's energy number 2, momentum. If it's weak, I'm not going to trade that trend, or I may fade the trend. If it's strong, okay, I'm still interested in trading in the direction of the trend. Then I move on to energy number 3. Now, when do I enter that trend? That's timing. That's the cycle. I'm watching my cycle indicator. Then number 4, I don't like to buy and sell breakouts. That's a valid method of trading. I'm not against it. I've got friends who trade it very, very successfully and make tons of money trading breakouts. But for my personality, I just find that I resonate with retraces better. So I'm looking for that retrace to bounce off support or resistance for me to get in. That's energy number 4. Then, before I take the trade, the whole thing has to be confirmed by energy number 5, the fractal energy, the bigger scale, the next higher time frame. And again, there I'm not looking for it to be confirmed by the trend of the higher time frame, but by the direction of momentum on the higher time frame. Let me give you a quick little example here. This will be the last chart I'm going to show you today, and we'll just put all of the energies together and show you exactly how I go through the 5 steps. So number 1, I'm looking to trade a new trend. By the way, when I trade with the trend, I want to trade early in the new trend. And by the way, early has a very clear definition as well, and that means the first 2 wave lows in an uptrend, the first 2 wave highs in the downtrend. The longer the trend continues, the less likely I consider it will continue. I'll actually look for reversal trades there. But here it gets above the 50 MA, retraces, and so now we're in a new trend. Okay, so energy number 1, yes, we've got a score of 1. Second thing, is it a strong trend or a weak trend? I go down to my momentum indicator. It's holding well above the 0 line here, so momentum's on my side. It's a strong trend. Still interested. Cycle low for timing. Here's our cycle low. And now we got a 3, go back to 4. Since I'm buying on a retrace, I need for it to bounce off a support level. The red line is the 50 fib. Great, got support. And finally 5, I go to my next higher time frame. Now, notice how the 50 MA is going down, but I'm looking to buy. However, momentum is going up, and cycle's also going up. All I care about is momentum because that is a faster indicator, potentially leading indicator. So that is supporting this trend or this trade. It's a 5 out of 5 trade, and therefore I would take it. Method's very robust, very adaptable. I do trade this on currencies, obviously. That's what we're talking about today. But I also use it on stocks, commodities, options, and futures. I do it investing. With my retirement account, swing trading, holding overnight, and day trading. It's a very robust methodology because we're just measuring energies. Whatever energies are on the chart, we're using objective instruments. They just measure whatever energy is on the chart, whatever time frame you put on there, whatever market you put on there. So I have a complete trading plan with this, obviously. I told you already about my little biofeedback thing, but we also have a way to do it for yourself, and I teach people how to do that, and simple little scorecard, which is basically going through the 5 energies. So here's my information. Again, I'm Dr. Barry Burns with Top Dog Trading. You're welcome to send me an email if you have any questions. We're out of time here. I don't have time for questions right now. I want to respect the next presenter. But you're very welcome to send me an email with any questions you might have at barry@topdogtrading.com. And then, oh yes, I also am offering all of you the free 5-day video correspondence course that has 5 days of videos. After the video, an interactive quiz to make sure you understood it and you get your grade right away. Included in that is one of my favorite trade setups with all the rules and filters in it, so you can start using that right away. And you get that all here at this webpage, www.topdogtrading.com/free.html. Make sure you put all of that in there, topdogtrading.com/free.html, and you will get your first video today if you fill out the form today. So thank you, everybody. Thank you, real traders. Thank you, other presenters today. It's been a great event. Really appreciate all of you and hope to work with you real soon.